Hello, everyone. Welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. The goal of this show is not to give you financial advice. There are plenty of great people out there to do so. We're not here to even give you advice around investments. Again, plenty of great people out there that can do that for you. The goal of our show is to help people become more financially knowledgeable and being able to read financial statements and analyze them for whatever the purpose is, whether you're thinking about investing in a company and need to know about the fundamentals, or if you're thinking about selling to a company and you would like to understand those financials, or even if you're planning on an interview with them and you want to really impress in the interview to gain that ever important role. This is the show for you. So don't forget to like, share, subscribe, and we will continue to post these videos out. So today we're going to be looking at a company that is a very well-known business, a company called Salesforce. So Salesforce started out initially as a software as a service CRM company. In fact, they were one of the vanguards for software as a service. Now, what's interesting is that, legend has it, or the history behind the founder, Mark Benioff. He used to be a VP at Oracle. He went to a Tony Robbins event and realized, he's not really happy being a VP at Oracle. And from then on, he founded Salesforce in 1999. And since then, this company has an incredible growth. So they've expanded from just CRM. They're now involved in analytics, where they acquired, for example, Tableau, which is an analytical software kind of dashboard business, software visualization business for about $15 billion. And they also acquired recently a company, which hopefully you all know of, called Slack, which they acquired for $27 billion. But they're involved in so many areas, including marketing, e-commerce, and even a net zero as a service company, which is involved in sustainability. So quite a sizable business. Just over $21 billion of revenue and around 36,000 employees. So this is a pretty big company that we're going to be looking at. Now, before we go into the analysis of their financial statement, just a quick note on the share price. Even though we're not helping you with investment, it's good to know how that share movement has been making as part of a rounded analysis. So if you'd invested when they floated in 2004, you would be sitting on a 5,254% increase. So quite a sizable growth there. In the last 5 years, you'd be sitting on a profit of, a growth of 159%. And in the last year, 0.95%. So they've been growing a lot since 2004. In fact, their compound annual growth rate over the last 20 years has been 51.22%, which is a pretty sizable number. So this is a company that's clearly doing something right. So we're going to go into the financials now and kind of just help you analyze those financials. We're going to be looking at the retrospective financials, so the audited annual statement, but this will help you look at any future financial statements that they publish, particularly those quarterly statements as well. So Ted, let's take it away and share with our viewers what we've uncovered about this company.
Excellent. Thank you very much, Moeed. Good to see you again. And actually, you were mentioning about a lot of our viewers. We are getting a lot of people who are perhaps doing an MBA, for example. They're doing their finance module. They need to analyze a company, and they found that we have done it for them. Please do like, share, subscribe, and do share these videos with your friends, with your colleagues, people who are studying finance, people who are becoming accountants, people who are studying for their MBAs. So it's not just people in the professional world, it's also people who are studying as well. And we are aiming to bring greater financial awareness, financial fluency to the world, one step at a time. So you're absolutely right. Here is Salesforce. So let's go and have a look at their financial statements. Now, Moeed, you mentioned we were going to have a look at the annual report and accounts, and here is the annual report and accounts, but actually we're not going to look at the audited annual report and accounts. This is for the full year 2021. We are actually going to look at the quarter for 2022. So here we have the full year fiscal results for 2022. Obviously not for the whole of 22, because we are still in March, but these are the numbers up to the end of February, so the 1st of March 2022. So these are unaudited and are subject to change, so they may well change. There's the caveat. However, why don't we look at them because they are giving us the full snapshot. Actually, I mentioned on March, it's going to be end of January. So there we go. We're looking at this column here. The full fiscal year ended the 31st of January. 31st of January 2022. So we're about 6 weeks, 7 weeks after these results have been finalized. So let's look at what the numbers are telling us. So first of all, we can see our top line. So we've got the revenue, which is subscription and support. So if you subscribe, if you've signed up to use their software, you're going to be in this, and then they're going to provide some little bit of other services as well. But we can see top line revenue, big growth. So we're looking at a 24% year on year from 2020 to 2021, and another 25% from 2021 to 2022. So top line is growing pretty consistently at 25%. Looks good. Next thing we notice is the cost of sales down here. So this cost of sales is relatively low, leaving them with a big, fat, healthy gross margin. So the gross margin, they're operating at about 70 to 71% gross margin, and that is looking pretty good. Scrolling a little bit further down, though, we notice that actually it's an expensive business to run. I thought this was slightly ironic that the marketing and sales was incredibly high. So marketing and sales itself is eating up a very, very big fat chunk of those profits. So this is a piece of sales software, and they've got to spend a lot of money selling the sales software. The irony was not lost on me. So that number is really eating up. That's about, and that leaves them with this really, a substantially small operating profit, EBIT, of about 2% margin. So the operating margin is 2%. They're making a little bit of strategic investment gains. They've got some other expense. I'm going to guess that some of that is interest, because there's no other interest anywhere. And I did notice they had a little bit of debt sitting on their balance sheet, and they're paying a little bit of tax here. So they're making a profit of 1.4 billion, nearly 1.5 billion. That's about a 5% bottom line net margin. But having been, so profitable up here, just really almost a license to print money. It's just interesting that, it's hard work. It doesn't sell itself. That's what I'm reading into this. They've got to go out and they've got to push it really, really hard. So probably some pretty aggressive marketing, and pretty aggressive sales, some pretty aggressive bonus targets, et cetera, et cetera, et cetera. So there we go. It's quite a tight margin business. It's it's not the license to print money that we might think it is. So there is our income statement. Let me just clear those annotations down. So let's go and have a look at the balance sheet, look at the strength of the company sitting behind it. So here's the balance sheet. So what do we see in the balance sheet? So in terms of their assets, and we're looking at the total assets here, 95 billion of assets. So the current assets are about $23 billion, and the big number there is cash. So they've got about, we take these two numbers together, marketable securities. These are bonds issued by other companies, other governments. So these are bonds which are issued by companies, and companies such as Salesforce, who have a lot of cash, tend to use marketable securities to park surplus cash. It's a bit like our deposit account. I guess that's what we could, and we came across that when we looked at people like Apple, for example. So 10 billion of cash, 10 billion of accounts receivable. There's no inventory, obviously, because they don't have any warehouse. It's a software company, and that really kind of is that's basically the current assets. Interesting here, costs capitalized to obtain revenue contracts. A little bit of a funny one coming up here. You don't often see that. So that's effectively saying, if you incur a cost today for a revenue stream you're going to be generating in the future, you're allowed to capitalize that cost and then match it to that future revenue stream. It's a little bit of a kind of a funny one, but just to be aware of that's what it is. and they're obviously allowed to do that under, I think they're prepared under IFRS. In terms of the non-current assets, really, they don't have any non-current assets. They've got, a little bit of property, plant and equipment, 2.8 billion, some lease assets. That's kind of the photocopier that's on hire purchase. So really, the big numbers are goodwill. And goodwill, we've discussed this before, Moe. This arises on acquisition of a company. And as you mentioned, they have bought companies and they've been buying companies recently. So we can see the goodwill has been going up. And the goodwill is effectively the difference between the fair value of the net assets and what you pay for a company. And when you buy a software company, you're paying a lot of money for basically two blokes in mum's attic. So there's a lot of goodwill inherently in that kind of nature of that business. If you were buying, I don't know, a utilities company, you'd be getting a lot of assets, and therefore the goodwill would be much, much smaller. So lots of goodwill, and that goodwill is because they have been growing through acquisition. So again, go back to that top line sales, 25%, looks pretty good. But if you're just buying that growth, then that's not as good as you would expect. So, is that growth coming from the salespeople selling, or is that growth coming from buying companies and just plugging them into the sort of the Salesforce network? And if they're buying companies, why are they spending so much money on salespeople? So there's a kind of, there's a few questions I think we need to be kind of asking of the company there. Come down to the bottom half of the balance sheet. So we've got the current liabilities, the amounts we owe and have to pay soon. There it is, 22 billion. Of that, we've got some suppliers, about 5 billion of suppliers. And the big number here is unearned revenue. So unearned revenue, just to remind those of you who are unfamiliar with the term, this is revenue I've received but not yet earned. So these guys will be selling, yearly subscriptions to use their software. And if they sell the subscription, if, for example, they sold it on the 1st of January, they can't book all 12 months into this year. They'd only book 1 month into this year, and the other 11 months they'd have to book into next year. And therefore, it would appear as unearned revenue, revenue I've received this year, but I haven't earned it. I'm going to earn it next year. So they owe it to next year, or they owe it back to their back to their customers. Now, they're not going to physically pay it. It's just a timing difference. So it's not like they've got to write a check for 15 billion at some point. But what that does tell me is that they've probably got very, very good cash flow. And again, 10 billion of cash in the bank, suggesting again that they've got some pretty good, strong cash flow coming through that. Next thing to notice, so these are current liabilities. Here are the non-current liabilities. Item to notice here is our non-current debt, and we notice that this has increased. So it was consistent 20 to 2021, and now it has increased up to about 11 billion from 2.7 billion. And again, we'll see that in the cash flow, and it looks to me like they've raised that money in order to buy some of these, to make some of these acquisitions. And again, I couldn't see any interest explicitly in the income statement, which is why I think that some of that kind of other expense is probably interest, if not all of it. So come down to the bottom half, to the equity. Let me just clear those annotations. So coming down to the bottom part, here's the equity. So the equity in the business, 58 billion, and that 58 billion is really 51 billion of investment by the shareholders and about 7 billion of retained profit. So the shareholders have put a phenomenally large amount of money into this company. And again, if you notice here, the difference between last year and this year, it's gone up by about 15 billion, suggesting that the company has raised more money through equity as well. So this movement here is the company has been borrowing money during the year, and this movement down here says that the company has been issuing shares. So they've been raising debt and equity to go on a spending spree and buy other companies. The retained earnings is not massive. Now, they're not paying out dividends, and we'll show you that in a minute. So they're making a little bit of profit, and they're just keeping that profit in the business. So this is very much a company that's growing, and it's growing through acquisition. Okay, there's making a little bit of profit, and it's reinvesting that profit, but that's not really driving the growth of this business. But it is still a very, very cash generative business, and that's probably reflected in the valuation. So otherwise, I mean, the balance sheet, the balance sheet's fine. There's no kind of warning signs out there. There's no kind of like, oh my gosh, are they going to survive the next year? Yeah, they're easily going to survive the next year. But we can just, we're starting to get a feel for their profitability and their underlying strategy. Here is the, let's just go down to the movement in equity, if I can find it. No, we haven't got a movement in equity, so don't worry about that. But they're not paying out dividends. You just have to take my word for that, I'm afraid. But what I can tell you is that they are, so here's the cash flow. And again, we're looking at the net cash provided by operating activities. This is our favorite figure, Moeed. Because this is the cash equivalent of their operating profit, or effectively their EBITDA, and it's 6 billion, up from 4.8 billion. So these guys, they are generating lots and lots of cash, and that is a good thing. If we scroll down the cash flow, we're going to see their investing activities. Now, investing activities, we need to be a little bit careful here. So I'm just going to highlight this. You really, if you're doing analysis of this, you need to remove these numbers, okay? This is not investment, okay? This is buying those bonds, those marketable securities, and selling those bonds. So these three numbers is basically a negative number is where they are parking money in a deposit account, and the positive numbers where they're taking it out. Now, the numbers are pretty similar to each other, so it's not going to make a big difference. So we've got 14.5 billion is given to us on the face of the cash flow. And if you remove those, you've got about 15.1 billion. So they're roughly the same. But those are distorting, and you can see the same for the previous year. We really need to ignore these. So we're interested in this line here. Look at that business combination. They spent 15 billion buying another business, purchase of strategic investments, and they're also selling a few. So this is buying companies and selling companies. So these two numbers are kind of buying companies, selling companies, business combinations, and then we've got the Capex itself. Now, Capex is pretty small, but again, it's a software company, so they're just buying a couple of Apple Macs for the office type of thing. It's probably a little bit bigger than that, but you kind of get the idea. So that's the investing activities, and then we can look at how they're financed. And we can see that the financing is predominantly coming from the proceeds of the issuing of debt. So there is the issuing of debt, the 8 billion. So that's where the 2 billion becomes the 10 billion on the debt side. There's a little bit of repayments of Slack convertible notes. So you mentioned Slack, which they bought, for example, there it is, and some proceeds from stock plans, etc. But really the big driver of this net cash provided by financing activities is these guys going out and borrowing money. Now, it's interesting because I mentioned when I looked at the balance sheet, I was talking about this number up here, and I was saying, look at the common stock or the additional paid in capital, and this additional paid in capital has increased by 15 billion. So if we're not seeing that as on the cash flow, then we should be able to find it in the movement in equity. And I'm just going to see if I can find the movement in equity note. So there's no equity note. So in effect, what they're kind of showing here is this business combination. So rather than making it as an acquisition, it's a kind of they're combining, and what they're doing is they're taking the equity from Slack and the equity from Salesforce and kind of putting them together and showing an increased amount of equity. So this isn't sort of them buying Slack from the shareholders to Slack. This is effectively putting those two together, and that's reflected in that equity movement. And so again, that's going to make the company, obviously much bigger. So there are the kind of, those are the key numbers. It's, so it's very profitable at the top line at gross margin, but less so right down the very bottom, 5% net margin. It's not huge, but it doesn't have too much debt. It's easily able to service the debt. Liquidity ratios are looking fine. It's got lots of cash sitting in the balance sheet. It looks like it potentially takes a long time to pay its suppliers. So so everything is looking pretty good. So let's go and have a look at the market value. So Don't forget we can analyze the company, and then we can go and look at the market and say, what does the market think of this company? Market cap 209 billion. Now, quite interesting here. I'm just going to pull up that set of accounts again, because if you look at the profit figure, the profit figure for the previous year, where's my profit and loss account, which is here it is. So the profit figure for the previous year, 4 billion. So there, it was 4 billion last year, and it's 1.4 billion this year. Now you can see that kind of the revenue has grown. The costs have the cost of revenues have grown. So the gross profit has grown. The cost of revenues has grown. The overheads have also grown as well. So we're kind of looking here at it's marginal as to kind of where those differences are coming from, but they do exist. And so when we look at this and it says a P ratio of 142, that looks to me like it's pretty expensive. But of course, if it was making a 4 billion profit, then suddenly that would become pretty reasonable. So this is a big company, which potentially, if it can go from 1 billion to 4 billion, and it looks like it can, then suddenly that P ratio, comes down to, still expensive, but comes down to a much more reasonable expense, if that makes sense. So 209 billion in terms of the market capitalization, about 144 times earnings, which is about a 7% yield. So suggests it's very, very expensive. It's a lot of goodwill in there, 151 million of goodwill, because the net assets, the equity on the balance sheet, it's about 58 billion. 8 times sales, if you want to value it on that. Yes, and there's no debt, so the enterprise value is about the same as the value of the equity. So I guess is it a buy? I mean, we could sort of take a chartist approach to this. So if I get my charting tools out, I kind of line it up like this and suggest that it's corrected down. It's a bit sort of toppy up here. It looks like it's going in the right direction, but I just kind of get the impression that it's growing through acquisition rather than really growing organically. And, I'm not saying that it can't carry on kind of growing, but, you've got to start delivering the bottom line. You've got to start delivering the profitability. They spend a lot of money on selling something which is, all about sales and meant to make your sales easier. So I'm not convinced that this is on my kind of, my list of screaming buys, or I'm going to be putting money into this particular piece of software. Now, again, I may be wrong. I don't use it. I've never used it. I'm not familiar with it, and I'm sure there's a lot of people out there who swear by it. So, again, if you're a viewer and you do use it and you love it, or you use it and you hate it, then do let us know. Obviously, be polite. Recognize that this is a company trying to make money out there. So do be polite in the comments box. But do give us your thoughts, whether you think it's a buy, whether you think it's a sell, whether you think it's part of your portfolio or not on your Nelly, so to speak. And there we go, Moe. That is my analysis of Salesforce for what it is worth.
Yeah, thank you for that. And just a note on there, Ted mentioned 151 million of goodwill. It's actually 151 billion of goodwill.
Billion, yeah, it is billion, yeah.
And Ted also mentioned something which is really a core thing around what we're trying to do here. Now, people look at reading financial statements and they kind of think, oh, well, this is difficult. It's just numbers, etc. But Ted said something here that was really critical. And he said, you get a feel for the company based upon what you're reading on the financials. And that's what's vital here. This is not just about reading the financial statement and become financial literate. It's more than that. Through the finances, you actually get a feel for the character of the company and the leaders and the executives involved in there. And what you get from Salesforce, at least what I get from Salesforce, is this is a company about domination. This is a company about expanding both market share, as well as they're trying to take the sales and marketing world, which is pretty fragmented and disjointed, and they're trying to put them together, right? They're trying to capture all of that. So anyone who's selling to a company like this, have that in the top of your mind. Actually, even an investment, that's part of that. And it's probably baked into the price. But if you're selling to a company like that, have that top of your mind. If you're talking to them about things like certainty and profitability, high profitability, that might be of interest for them. But what you can get from reading the financial statement is they're about more than that. They're trying to do something else here. And they probably believe that profitability will come later as they continue to dominate this market and world. So hopefully that's of value to all of you. Please, as Ted said, leave your notes in the comment section. Now, this particular company wasn't a request. It's one of the very few that isn't a request. Most of ours are, like 98% of them are. However, if you do have a company that you would like us to analyze for you, whether you're thinking about investing in them, selling to them, or working for them, do leave a note in the comment section. Leave a description as well to give us some context. And who knows, if your context is good enough, we might bump you up in terms of priority list. So as again, like, share, subscribe, and we'll see you on the next video. Thank you, Ted, and thank you, everyone else.
Good to see you, Moeed. Catch you later.